So we're very pleased to have with us today Jim Chessen, the Executive Vice President and Chief Economist of the American Bankers Association. In his role with the ABA, Jim oversees economic policy and research, the Benchmarking and Survey Research Group, the Center for Payments and Cybersecurity, and the International Monetary Conference Secretariat. Prior to joining the ABA in March 1998, Jim worked as a financial economist with the FDIC. He's well known throughout the financial industry, and he was a trusted advisor during the Great Recession and helped banks, like Webster Bank, navigate through those challenging times. We reached out to Jim Smith, and I wanted to get a little personal anecdote, and Jim reported that in late 2007, Jim presented at the American Bankers Council, illustrating the level of risk in the mortgage market. He suggested that leverage was high, and with just 2% decline in housing prices, the GSEs would be in a negative equity position. This was in direct conflict with what the regulatory leaders were saying, which was that the market was fine and that there was no risk of insolvency at that time. Well, we all know the story, and Jim was right. For more than 30 years, banks large and small have relied on Jim for his thoughtful analysis and perspective. He remains a vital asset to our industry. Thank you so much for being with us today. Ladies and gentlemen, Jim Chessen.
Thank you, John. I have to say, I don't know if anybody noticed the music that was playing before John got up. Best walk-on music for a CEO, don't you think? For all those baseball fans that love that. It's really a pleasure to be here, and congratulations, John, on such a great year. I'm sure you agree it helps to stand on the shoulders of a giant like Jim Smith. I've known Jim Smith for 2 or maybe 3 decades now, and it's really been a pleasure. And thank you for Webster Bank to be a part of ABA. We need leaders like you to be part of what we try to do in Washington. As John said, I've titled this The Good, the Bad, and the Ugly. My wife said it's overdone, people use this, but frankly, I like the pictures. Now, let's be honest, how many of you have never seen this movie? A couple cultural gaps we need to fill there, but most people have. But this is a theme I keep going back to, and so I want to talk about the good here, which is, in spite of a self-inflicted head wound of shutting the government down, we have a very strong economy, and it's based on consumers driving that. And what I want to paint for a picture of the good is the strength of the consumer sector, which drives 2/3, 3/4 of our economy. What you're seeing here, I can't see the slide, so I'll look down here. What you're seeing here is our Economic Advisory Committee, which is 14 chief economists around the major banks. They do a consensus forecast. They meet with the Federal Reserve Board, have a press conference. This is their forecast for GDP growth going out. So the most obvious thing you see is it's likely that the economy will slow down. That's not surprising. Now, a couple things happened. The fourth quarter, the second and third quarter, of course, were great quarters, supercharged by the tax bill. The fourth quarter was supposed to be about 2.7, knocked that down about 1/10, maybe a little bit more because of the government shutdown. The real impact is going to be in the first quarter. So our estimate from the EAC was about an economy that would grow in the first quarter about 2.2%. Knock that down by probably 3/10, maybe 5/10. So in the first quarter, we're likely, because of the shutdown, to have a GDP of about 1.7, maybe 1.8. It would ease up. Some of that comes back in the next quarter, the second quarter, because the workers did get paid. They're back buying things, but it doesn't all come back. You don't buy 2 lunches because you missed a lunch when there was a shutdown. You don't buy some things that you gave back up. So not all of it will come back, and the best estimate is about 2/10 will not come back that we've knocked out. And so one of the things I was mentioning to Jim earlier, we spent a lot of time thinking about $5 billion for a wall. And whether or not you care about the wall, you like or hate Trump or the Republicans or the Democrats, we blew by $5 billion within a couple weeks of the shutdown. There's more important things that we need to be thinking about other than arguing about small dollar things of little consequence that actually end up hurting the economy. The other thing that's going to happen in the second quarter, there's a couple important things that are going to happen. One, we still have to get through another shutdown in another week or so. That debate will happen. The second thing that will happen is on March 1st. Anybody know what happens on March 1st? We hit a debt ceiling limit again. At $22 trillion, we hit another debt ceiling which Congress has to extend. They extended that for a year. What will they do on that? The third big thing that's going to happen in the third quarter is there's going to be tax returns. So for the first time under the new tax regime, there's going to be a fair amount of money that may come back in the form of tax rebates for the first time on that. But another consequence for real estate, it's the first time in high tax states, and you're up in several of those here, the high tax states are going to be the first time when people are not going to have the state and local tax deduction, which I think is going to have a bigger impact on some of the real estate when people realize what they're really paying for their home. But when you look at this chart, even though it's declining, the average is going to be about 2.3% GDP. That's what we've had on average over the last 10 years. So is it fabulous? No, but it's pretty strong there, and it's, you know, a reasonable growth rate. What about a recession? There's, from our Economic Advisory Committee, they say there's about 20% chance of a recession this year. Now, spoiler alert, there's always a 20% chance of recession. Why is that? Because sometimes we do stupid things like shut the government down for no apparent reason on that. And if it carried on many more weeks, we could have knocked the GDP down to 0 in the first quarter there. So 20%, but it goes up. Our Economic Advisory Committee says it'll go up to 35% next year and 40% the year after. So clearly the economy's slowing down, and we'll talk about some of what that means. Oops, went too fast. The second really important thing, and this is a transition to the consumer, is what's happening with job growth. Really good January numbers, surprised everybody, over 300,000 jobs that were created. And you can see what the pattern is. Our Economic Advisory Committee's forecasting it goes down. So when you look at the numbers, last year, over 200,000 per month. This year, probably 160. And the year after that, probably 120. Well, some of that makes sense, right? Because we have been employing a lot of people. We have the unemployment rate being exceptionally low. It wouldn't be surprising that you see it tail off. The biggest complaint of small businesses, and I'm sure you've heard that as you get out with your clients, is they can't find qualified workers. So one of the amazing things about it is that if you look at the yellow bars on that chart, that's 10 million jobs that have been created just since 2015. If you look at the green bars for 2019, that's almost another 2 million jobs that are being created. So think about that, 2 million jobs for this year, and there are 6.2 million people unemployed. So wrap your head around that number. How can that be? Well, it's got to be that we're pulling in people that weren't in the labor force. And in fact, the new numbers that just came out last week said that 75% of new entrants into the job market were not in the labor force the month before. They were not technically unemployed. That means they found a job within the first month of looking and they hadn't been in the labor force. Now, we still have other issues. 20% of people have been unemployed for more than 6 months and are still looking for a job. That's a challenge, but it was 40%. So 20% is better, but it's still almost at the top of other previous recessions. So jobs are still plentiful. That's good. The unemployment rate is low. Well, the other striking thing is look at this chart where the green bar is job openings and compare that to the unemployed. That means there's 870,000 more jobs than there are people that are unemployed to fill that. So a strong labor market, that's obviously good for consumers. The other thing that's good for consumers is wages are rising. Our EAC says that they think wages will rise this year at about 3.4%. It's actually positive in real terms. You can see what the trends are. That's good. Look at household spending and compare that with income. So there's some variations. You can see the comparison with the blue and the orange lines here. But the message is consumers are pretty much spending within their means. There's periods where they spend more than their income, when we had kind of the mini recession back in 2015, or a slowdown there. But consumers' wages are going and they're spending within their means. And what is it about their leverage? This is just a simple example. There's more things about leverage. But this is credit card debt to personal disposable income. Look what it was pre-recession, and look what it's been now. And look at how low it stayed for a long period of time. Consumers de-levered there, and they haven't levered up much when it comes to credit cards. The same thing we see on delinquencies. ABA tracks consumer credit delinquencies, and through all kinds, whether it's auto loans or personal loans, or in this case we put credit card loans, and look at how low credit card delinquencies have been for a long period of time. Now they're starting to come up, but it's still low relatively. So when you look back at the consumer, you say there's plenty of jobs, wages are rising, they've de-levered and not levering up, they're meeting their obligations, they're paying it. There's a huge amount of energy in this economy because consumers have the financial wherewithal to continue to drive the economy forward. And that's why you've seen in this chart, you've seen consumers with their sentiment has consistently risen over time. Now, there's a change, as you can see, just at the last part where consumer sentiment has started to drop. I think we'll see more of that because of the shutdown here. And one of the concerns is there's beginning to be a bigger gap between the future expectations, which is that green bar, and the current expectations. So people are not quite as confident as they were before. Businesses are also confident. I'm not going to talk a lot about businesses today. I think the driver will be consumers. If consumers feel good, they will continue to drive this economy. But businesses have been feeling pretty good about things. And you can see when the election, when the tax bill, very high rates historically. But what I want to point out is it's the delta that matters. It's that change that matters. You can still have high confidence, but people get nervous when they see things happening and business confidence goes down. That's been a cut in half in terms of the outlook for small businesses. And when small businesses were asked, well, what is the reason that you're less confident? Some said, well, the economy, it's starting to slow down. But there was a big increase of people saying it's the political uncertainty that's leading us to be less confident. So that leads to the bad. You gotta love that picture, really, seriously. You gotta love that picture. So, what's happening out there? We've started to get headlines of things about the shutdown, about the slowdown, about recessions, about Germany having a negative GDP, about Italy's banking problems, about problems in France, about China slowing down. All these things are compounding risks that affect how we think about things. So, I used to say that I was an emotional optimist. Now I'm becoming an emotional pessimist. I'm becoming a statistical optimist, which is really weird, but I'm becoming an emotional pessimist because of these compounding risks. And one of the things John mentioned that we made it through the Great Recession, and that was an interesting time for everybody. But this is a chart that I used to show when we were coming out of the Great Recession. This is Maslow's hierarchy of needs. I don't know how many of you are familiar with this whole concept. Yeah, most of you are. And what occurred to me then, and really I'm starting to get the same feeling, is when people get nervous, what do? They start hunkering down. You know, they used to be spending money. As they move up that pyramid, they're feeling better about things. There's greater self-esteem. They want to spend money. They're more outreach in the community. When they're nervous, what do? They stop spending. They want to be with their family. They get down in safety matters. They start driving down into the bottom of that pyramid because they're nervous about it. And when they stop buying things, when they get nervous and they don't go out and spend money, the whole economy takes a shift downward. And I think that's starting to happen now. There's so much uncertainty and nervousness. And all of you who deal with your business customers, uncertainty freezes business decisions. They don't want to go forward if there's uncertain because it's too risky in their minds. Another thing that happened that's sort of in the bad category here is that mortgage rates started to rise. So you can see the 30-year mortgage rate there in the yellow bar. And notice it's a little bouncing around there, but notice the blue line is existing home sales. Existing home sales started to fall back down. The interest rate increases started to pinch there. And so there's consequences to that. And one of those is brought me back to this chart, which is one of my all-time favorite charts. You can imagine I have a lot of favorite charts. It's sad, I know. I am an economist. We like our charts. But this is a chart that strikes me, explains a whole lot about what happens in our economy. So it goes back 50 years. It's housing starts. The white line that you see across there is pretty much the kind of housing you need to replace all the houses that are deteriorating and falling apart, all the new immigration, new household formations, the regular stock of the growth of the population. So a couple things you see on this. One is every major recession we've had has been associated with a real estate downturn. That's the little shaded bars there. Every recession. Housing is big in this economy. The other thing that you see is look at how pathetic we have been with the real estate markets coming back since the Great Recession. It has taken us a long time. Now, for all of you that are doing commercial real estate is about back to its historical long-run average. It's very close to that line. Residential real estate is still only 75% of a normal range that's out there. So this chart says a lot about what happens in our economy and where things have to change in the future and why there's still a lot of capacity there. The bigger thing, and Jim may remember this from the past, is a chart that we were tracking, a very simple measure. It said, let's compare average hourly earnings to the median home price. And we started doing that back just before the Great Recession. And you can see how the home prices started to get out of whack with average wages. And then we came back after all the disruption with the Great Recession, and we were back down for normal for a couple of years. Look what's happening now. We're back in a situation where home prices are starting to really diverge from wages. So the question for all of you is that sustainable? How can you have wages, how can you have home prices rise faster than the capacity of people to buy those houses? It's a simple measure, and I'm sure we can all quibble about, is it predictive, does it make sense? It's a simple measure that talks about the importance of what's happening in housing. Oops, went too far there. Let's talk about the Fed, because no economist can ever speak at a group of bankers without talking about the Fed. So the first thing is, this is the balance sheet of the Fed. I'm sure all of you have probably seen something like this. The great thing about this slide is it shows the QE1, QE2, and QE3 very distinctly, and it can show you now the roll-off of the Fed, and that's become more important because the Fed is rolling off $50 billion a month out of their portfolio. They've already rolled off $400 billion in that. That has consequences for interest rates here. The question is, where do they end up here? How much are they going to be aggressive in this market? And the best guess now is they're going to end up at about $3.5 trillion as their portfolio. That's why we've kind of cut it here at $3.5 trillion. The original thing had it going further on that. So it has consequences, but the Fed has said, we're about halfway done here. And when we're about halfway done, we have the ability to be more patient in how we let this run off. And at some point, because if you look at the blue bars there, that's mortgage-backed securities. At some point, they will move to start replacing those mortgage-backed securities with Treasury securities. And the size is not the only thing that matters here. It's what is the composition of that. Do they start shifting away from riskier assets, away from mortgage-backed securities, away from 10-year Treasuries to shorter maturities? I think that's what will happen. That will take some time to do. Well, what is the Fed going to do? You all, I'm sure, saw the press conference. Our best guess is the Fed will do one increase probably in the fall, 125 basis points. What is the logic of that? Well, this gives you a sense of where the Fed is. The Fed is in the blue compared to where other major central banks are. So one of the constraints we always said is, how far out of whack can the Fed be relative to all other major currencies, all other major central banks? You can't get too far out of whack because bad things happen. You have capital that moves into the U.S. from other countries, particularly from emerging markets. So we're at a high of 250 now. The Fed says the long-run rate is 2.8, so we're within 25 basis points of being close to what the Fed says is the long-term rate. Would they need to go beyond that? Probably not. If you think 2.8 is the right rate, why would you go beyond that? The thing that will matter, the thing that they cited was global slowdown, which is absolutely true, particularly coming out of China, had a negative quarter for Germany and Italy. Those are things that matter. The trade uncertainty matters with that. So that's one of the big things that they cited. The other is inflation. So if you're going to look for anything, if inflation picks up, and picks up in a big way where that delta matters, the Fed is more likely to move. That's what they're paying attention to now. Well, let's go to the ugly. You know, there's a lot of things that we can control and that we worry about, but there's some bigger picture things that really make a difference here. The first is some demographic trends that really are not going to reverse anytime soon. So the yellow is the working age population. So you can see that starting to fall off. And the orange is the labor force participation rate there. So the scary part is you can see, in general, they have been going down there, particularly the yellow bar. If you move back and look at the 70s and 80s, what was happening back then? Women were entering the labor force in a big way. The baby boomers were jumping into the labor force in a big way. It's not happening now, and I'll show you another chart, particularly about women participation. We started to see it turn up. That's good. But what does this chart tell you, or what does it tell me? It says that if you have expectations that we will be a country that will have 3% plus GDP, I think you're dreaming. This says that we will be lucky to have a 2% GDP growth given the demographics of what's happening with the labor force and the participation rate. And just to focus you on that, if you just look at the labor force, to have a sustainable 3% GDP, you need 4 times the growth of that labor force than what we have today. 4 times. You have to get back to what it was with women and the baby boomers for that labor force growth to drive a 3% on its own. Same thing with productivity. You have to have productivity twice as high as it is today. to drive a 3% GDP. It is not going to happen. That's why the revisions have gone down to 2% in spite of what any politician might tell you. There is a bit of good news here. This is the female prime age labor force participation. As we said, big increases occurred in the 70s, 80s. But look what happened, there's been a subtle downturn, but look what happened after 2009, after the financial crisis. Women, for the first time, were really dropping out of the labor force. The good news is they're starting to come back, and in fact, the labor force participation for women is about what it was at the peak right before the Great recession that occurred. So that's good news. Men are coming back up, but men have been in a long-term decline for many years. Well, here's another really scary picture. Again, we worry about $5 billion, and we argue about that, shut the government, impose a lot of things. And again, congratulations to Webster and Jim for stepping up for that program. But this is what our budget deficit is every year. The little dotted line there is $1 trillion. That's $1 trillion every year. It's going in the wrong direction, and we've got a strong economy. These are the things, if we don't change anything about what we're doing, this is kind of the pattern, and you end up with a chart that looks like this. Now, this is you got to admit, this is a good-looking chart. And also, the greatest thing about this chart is it goes back to 1790. Now, how many charts have you seen that go back to 1790? You got to give it up for this chart. Come on, really, seriously. 1790. And look at where the peaks of our federal debt held by the public, it's been largely related to wars. The dotted line is where we are today. We're still behind what we had in World War II, but look at what the trends are if we don't change our policies. This is OMB numbers, the Congressional Budget Office, rather, numbers. This is Congress's own numbers saying bad things are going to happen if we don't do something. And what happens? You're all bankers. Take $22 trillion, apply whatever interest rate you want. It's a lot of money. This is what happens to the interest payments as a share of GDP. It goes up to 6 and 7% of GDP. That's more than we have in Social Security and Medicare. Now, it is not sustainable. You can't keep having debt rise and having this. You all know what that does. It crowds out private sector investment. And besides what happens in the US with our debt level, it's been happening globally. So this is the global levels of debt. So it's up to $200 trillion globally, which is shocking to me. And what we've done is, you can see by this, we've tried to do 2007 and 2007 and 2014. Because the interesting part about that is between 2000 and 2007, right before the Great Recession, it was largely in financial and households where the debt was being created. Since that time, the next 7 years, it was in governments and corporate debt. But if you look at those bars, look at the one with 2000, 2007, and 2014, we have created just as much debt in the 7 years after the Great Recession than we did in the 7 years prior to the Great Recession. Now, that ought to scare you. Now, interest rates have been low. It's been great for corporate borrowers. We don't have a chart. I'm happy to share it with you. The amount of BBB credits out there have jumped way up because things are cheap and people can get that. Corporate debt is an issue. And I don't have a chart here, but China's debt is off the charts. They've got a 6.6% estimated growth. How do they do that? They are pumping a lot of debt into their economy. That matters. It matters globally. Can it be sustainable? Now, they have a government. Their government debt is not so large, so they're able to sustain that with their government. I don't know if that gives you a lot of confidence. Doesn't give me a lot of confidence. But what happens in China matters a lot to Europe, to emerging markets, and of course to the U.S. So let me quickly summarize here of what we've kind of said today. So the first is the current economic fundamentals are positive. A slowdown in the economy is not a recession, and often the media confuses that. But there's a lot of energy with consumers going forward. They're the ones that are going to drive it, provided they have the confidence to do that. That's where the second point, risks are compounding. The third thing is there's a lot of policy uncertainty, whether it's trade, whether it's a government shutdown that may occur again, whether it's the debt ceiling, whether it's fiscal, global. That uncertainty has consequences that I think is more. And again, back to John's comments about knock on wood. Everybody's knocking on wood because it doesn't feel right, even though we can be statistical optimists, right? Statistically, it looks good. We've had a great year. The markets are good, but people are feeling uneasy. And geopolitical turmoil is always an issue. Recessions just don't magically happen. It happens because bad stuff happens somewhere that triggers an event. So I've probably given you some good things to think about and maybe some depressing things, but what I always try to do now, and I took this from a good friend of mine who's an economist for Raymond James, is I try to end with puppies. Because everybody loves puppies. So anyway, thank you very much, John. It's really been a pleasure. Jim, great to see you again. Good luck for 2019.